Hey everyone, thanks for taking a minute to take a look at our newest offering at 823 North June Street. My name is Matt Heinz. I'm the Director of Investor Relations, and I wanted to take a minute to walk you through some of the details about this investment, and that includes construction, development, as well as the financials. So on this landing page, the default is to come to a gallery, and you'll notice a beautiful rendering of the property that we're working with our architect to design and build. As always, we pride ourselves on building high quality developments that are modern, attractive, aesthetically pleasing. And that's part of our core proposition, our value thesis. We are able to sustain premium rents with minimal occupancy and minimal vacancy because we develop properties that people want to live in. This property is located in beautiful Hancock Park. If you take a look here next to gallery, there's a button for map. If you're familiar with Los Angeles, you probably are familiar with Hancock Park. If not, let me take a minute to tell you a little bit about it. So Hancock Park is located right here by this red balloon. It's located right by Hollywood. It's very, very close to downtown Los Angeles. It offers easy accessibility via the 101 freeway. It's close to Sunset Boulevard, Melrose Avenue. It's centrally located. We have deep expertise and experience building in this mid-Wilshire type of area of Los Angeles. We have been building for over 10 years, and we focus on multifamily development. We build properties with 4 units, 5 units, 6 units, and that's allowed us to become market leaders. We don't try to be all things to all people. And this is what we know, and Hancock Park is a perfect area and opportunity for that. So if you take a look at below the map, below the gallery, we have a little bit of an investment summary, some property highlights. But if you'd like to read and learn a little bit more, over here we have some documents. So first you can take a look at our June offering memorandum. So I'm going to click on that, open it up, and that'll walk you through. So in this offering memorandum, we have some information about our current offering in June. We have another offering which is located, I'm going to scroll through the financials because we'll spend plenty of time on that later. We have another offering right now on West Boulevard. See, look at that. It's beautiful. I mean, I know I'm biased, but that is a beautiful, beautiful design. We're excited to build it. We also have some information about a project that is underway that is fully subscribed at 1348 South Burnside. And when we develop, we have a very deep understanding of what residents are looking for. These are 4 townhouses, rooftop terraces, covered parking, right? Look at these rooftop terraces. If you know Burnside, it's right off of Pico Boulevard in the mid-Wilshire, the Wilshire Vista neighborhood. We have views of the Hollywood sign. We're going to build that on June. We know what it is attractive for people to feel like they're at home. One of the things that I always like to encourage potential investors to do is take a look at some of the properties that we've built. So we have a property, for example, on 1245 Plymouth. Notice it's 100% leased. Premium rents, 100% leased. We have a property on Van Ness, and you'll start to recognize our construction style. As I mentioned, this is something that we've been doing for over 10 years as RCF Development, and the managing member and principal, Richard Francis, is also a partner in Ocean Construction. So Ocean Construction has built over about 200 restaurants nationwide, a lot of restaurants in Los Angeles. If you've eaten out in the city of Los Angeles, chances are you've been at one of our restaurants. So we've built a lot of restaurants, a lot of projects such as schools, and of course, we've built tons of custom homes and multifamily properties. And one of the things that we really is part of our difference at RCF Development is that we're vertically integrated. And what that means to you is that we design, we develop, we handle all of the construction, we handle the property management. And this is, in our experience, this is minimized execution risk. We have a long track record of building projects on time, building them on budget, and making sure that the properties always adhere to the highest possible quality. And that's important because it's that high quality that minimizes maintenance expense during our holding period, whether that's 5 years or 7 years or 10 years. That high quality construction translates to a better resident experience, and it also leads to maximum sales price when we choose to exit the investment. So I encourage you to go, if you're interested, to oceangroupca.com, and you can take a look at some of the projects that have been built at Ocean Construction, including lots of restaurants, lots of other developments, as well as some multifamily properties. Okay, so let's get back to the property at June. So over here we have the offering memorandum, and of course you can take a look at the financial projections. Want to make sure that that we have a conversation about the fact that these are projections. These statements are pro forma. If you have any questions, please reach out. In a past life, I was a professor of finance, and so I am always happy to have conversations about where the assumptions came from and how the model is built. And I encourage you to kick the tires and see for yourself if you believe the assumptions. I think they're reasonable. I think they're conservative, but I'm always happy to have a conversation. And as a teacher, my goal is to make sure that you understand and that we have an alignment as far as that goes. So if we click on the financial projections, you can open up an Excel spreadsheet that will walk you through our assumptions. So at the bottom, we have a whole bunch of tabs. Let's start with our assumptions. So 823 North June Street is going to be 4 units, 4 townhouse units, and we project a monthly gross rent of $6,000. What I will tell you is that we have several properties. For example, we have a property on Plymouth that is about 1.5 miles in the bad direction that has rental rates that are significant, about $6,200, $6,300. So we think that if you move a mile or so in the good direction, $6,000 is very conservative. But we like conservative assumptions. We want to underpromise and overdeliver. We have some pretty standard assumptions as far as vacancy and maintenance. And of course, we have our standard property management fee so that we can make sure that the places are leased and that there's someone to answer the phone for the tenants, as well as fund management for making sure that all of this is handled on the investor side. One way for you to kind of kick the tires a little bit and see if these are in the ballpark. I'm jumping a little bit, but if you take a look at the financial analysis, when we work with a lot of creditors like Capital One or Goldman Sachs or whatever, one of the things that you can do is take a look at your potential gross income, which is simply the rent times the number of units. That gives you your potential gross income per month. Then we multiply times 12, you get per year. So we have potential gross income of $288,000. We have net operating income of $205,000. Take a look at those expenses, $74,000, 74,074 divided by the potential gross income of $288, and it's about 26%. That is going to kind of change a little bit over time, but we find that in our experience, when we build these properties at a really high level of quality, our expenses are always somewhere in that 26 to 30% range. If it's an older building, if Capital One is looking to do a refinance for us, they might expect expenses in that 31, 32% range. But in our experience, this is a very reasonable expense ratio, meaning that, right around 75-ish, 74, 75% flows through to net operating income. From that, we pay our mortgage expense. So let's go back to our assumptions. On this property, as with most of the properties I think actually all the properties in our development currently in our portfolio, we plan to get an interest-only loan. We have several partners that we work with. One of our most outstanding partners is Capital One, and we are generally able to obtain interest-only loans, so that is our intention with this property. Now, a lot can happen during the 16 or so months of development and construction until we actually get to the point of opening the doors and renting these units, but we are right now in a historically low interest rate environment. We find it advantageous to use significant leverage because in our kind of estimation, money is historically cheap. So right now we're getting interest-only loans that are more like 3.5, 3.75% interest. But again, just to be conservative, if we assume that interest rates move even a little bit during the time of development and construction, we think that we'll still be able to secure money at 4.25% or better. So that's our interest-only loan. Now that interest-only loan is going to be at the point of completion, which again is 16 months from now. How do we get there? So here's our project budget. I'm happy to share with you a little bit more of a fleshed out budget, but right now we just have a single value for construction costs. So the company has already secured the land at a cost of about $1.65 million. We have some soft costs, which are the carrying costs over the next 16 months. So obviously there's going to be some interest expense associated with the loans, the construction loans. There's property taxes and insurance and architects and legal fees. And so we have projected that, again, based on our experience, to be about $305,000. Construction cost is estimated at about $275 per square foot. We have been able to deliver time and time again at that rate. Sometimes we do a little bit better. Sometimes it's slightly off from that, which is why we have a contingency that's just under 10%. Okay, so 3.8 million. How do we get there? So let's talk a little bit about the capital stack. I don't know if you'll be able to see that, so let me zoom in. Okay, so this contemplated investment, we are looking to raise $1.35 million in equity. And the way that that's going to come is 1.17 million that is going to be external, raised from limited partners, people such as yourself, and the sponsor, RCF Development, is going to contribute $180,000. Now you will notice that $180,000, the sponsor is 10%, but that 180 is not 10% of 1.35 million. How does the math work? Well, with most of our deals, the general partner, if you take a look over here, the general partner receives 25% of the equity as consideration for the fact that, again, RCF Development's been doing this for 10 plus years and has been able to provide really, really attractive returns on a repeated basis. So the limited partners will acquire 65 units at a cost of $1.17 million. And the way that that works out is that for each 5%, which is the minimum investment, the investor will contribute $90,000. So for 10%, the sponsor is going to contribute $180,000. And in addition, the sponsor, RC, Richard Cooper Francis, RCF Development, is also going to receive 25%. So in this deal, the sponsor is going to have a lot of skin in the game and going to have 35% of the outstanding membership units. The total raise is $1.35 million. Now, from those equity proceeds, we're going to receive a developer fee of 5%, and that's 5% based upon the deal size, not the equity. So in other words, it's not 5% of 1.35 million, it's 5% of the deal, 3.8 million. And there's also an acquisition fee. And there were a lot of properties that we looked at and a lot of costs that were incurred to get us to this point. The relationships that we've built with lenders such as Goldman Sachs or Finance of America, the due diligence, people like myself, a lot of this stuff, it took us a lot to get to the altar so that we could be in a position to now say, yes, I do. So if you put all of this together, what that means is that we're going to raise $1.35 million. We have already secured a loan of $1.272 million. And again, that's with Genesis. Genesis is a division, or I don't know if it's a subsidiary. I got to be careful of language, but it works with Goldman Sachs, and they're our construction lender for most of these deals. So we have already secured, it says 10-1, but we've already secured that. On 10-1, it would be transferred. That obligation would be transferred from RCF Development to this entity once we have completed the financing with equity investors. We're going to go through our permitting, and we envision breaking ground by January 1st of 2020. We would secure an additional construction loan, and that would allow us to get to completion. So if you put those two together, we will have taken on construction financing of $3.105 million, and that would be the amount of money that we were looking to raise in permanent financing, which goes back to that construction loan, that permanent loan that would be interest only that we talked about earlier. So that is our capital stack. Now, you're welcome to take a look at our capital and fees timeline. This can kind of like, for accountants, you might think of this as, it's kind of like our statement of cash flows. We're just making sure that the cash works. And so this is our timeline as far as that goes. We have a financial analysis, which I talked a little bit about before, but let me just kind of again, so we have our potential gross income, we have our operating expenses and net operating income. If you subtract your mortgage expense, that determines the annual cash flow. Okay. Now, as with any real estate investment, the interest expense is going to be deducted at the entity level. Okay, so the entity, the LLC of June 823 Avenue LLC, is going to subtract $131,000, $205,000, and so the $73,000 of cash flow in year one is what's going to flow through to investors. Now it flows through on a it flows through on a pro rata, right? So 10% of that, or $7,331.10, would flow through to a 10% member. Okay, it's all pro rata, pari passu. The interest expense creates a tax benefit because it lowers what flows through to you. Now, depreciation, on the other hand, is not going to be deducted at the entity level, but rather is going to flow through to you, the investor. And so that depreciation is going to, again, flow pro rata so that you can use that depreciation, which is a deductible expense, to reduce your individual tax liability as well. So there's a significant tax benefit to you from the depreciation, which is not included in some of the traditional return metrics. Now, if we scroll down here, we have a little bit of an indication of the equity accumulation. Let's talk first about property value. So for a Class A, or let's be clear, really A+, but for a Class A property such as this and the other properties in our portfolio, we use an estimated capitalization rate of 4%. What does that mean? Well, if you take your net operating income of $205,000 and divide it by your cap rate of 0.04, that gives you an estimate of property value. 4% for a property like this in a neighborhood like this, we think is fairly conservative. We see some Class A properties going for 3.25%, 3.5%. Now, a lot of people ask, well, look, 4% is historically low. Well, not necessarily for Los Angeles, but I agree that it won't always be 4%. So what does that mean? Well, we like to make sure that people have a long horizon for investments with us. That's why we are always selective about the partners that we work with. With our investments, we typically look for windows of opportunity. I can't guarantee that cap rates are going to stay at 4% forever. In fact, I can guarantee that they're not. But I do believe, based on history, that they will return to 4%. So the company's proposition is, starting around 5 years post-completion, if the market is in a good position and cap rates are nice and low, like 4%, then we will look for an opportunity to exit. If not, then we will potentially look for an opportunity to refinance, to cash out the equity investors that are looking to exit, but we are going to be more interested in holding. We will hold it until year 6, year 7, year 10, so that we can capitalize on the windows of opportunity. Our holding period is going to be a range rather than a single point in time, because we want to make sure that we're as close to maximizing the exit value as possible. In our experience, we're able to maintain high occupancy or low vacancy. And as such, by maintaining low vacancy, we know that we're going to have significant cash flow, substantial cash flow to flow through to investors to meet all of our obligations in terms of expenses and interest and all that. And we position the company to weather any financial crises such as many of us experienced over a decade ago. So our position, our proposition always is to hold and to wait for the windows of opportunity so we can maximize the value upon exit. If you take a look, our cash-on-cash return is attractive. The property IRR, I mean, look, it's just mathematics. IRR will generally converge or decline over time, but whether we wind up holding it 5 years, 6 years, 7 years, 10 years, the property IRR is attractive. Our debt service coverage ratio is more than sufficient to make sure that we are going to be able to obtain, or in projected, going to be able to obtain the amount of permanent financing that we are interested in obtaining. And so that finally brings us to our investment projections. They're just, again, the way that the math works and the way the deal's structured is that the property's return is not necessarily the same, or is not the same as the investor's return. So we created investment projections. Now these are, again, post-completion. So in other words, year 0 is kind of the day that we open and sign our first leases. So this is year 1 of operation. Not 1 year from now, but 1 year post-completion. So for a hypothetical 10% owner, we have our income. We have some tax benefit. I just wanted to put in a hypothetical. For here, I just used a marginal tax rate of 40%, which is, especially for California investors, which is probably pretty conservative. But so then I calculated the effective annual income. So for a 10% member that makes an initial investment of $180,000, they're going to have equity cash out. So this shows the equity cash out at various times. And I highlighted year 5 and year 7 for your consideration. So just not getting into too much crazy finance. We can calculate IRRs and whatnot, but just looking at return, we said, okay, what if we then, for example, year 5, take your equity cash out, so $248,000, and add all of your accumulated income. So take a look at all of the cash. Just add all those up as well. So I'm ignoring time value of money, and the finance professor in me, yes, my head hurts doing things too simply, but that's okay. I'll swallow my pride. So if we add all that up as well as the equity cash out, we have a total return, and then I simply just divide that by 5 because that's your return over 5 years. Divide by 5 to get an average annual return. So over a 5-year period, we have 12.38%. If I include the tax benefits due to depreciation, which are very real, that's real money. What did Ben Franklin say? Penny saved is a penny earned. So if depreciation creates a tax shield, that's as good as getting a check. That's money in your pocket. But anyway, so when we incorporate that, there's an estimate of your average effective return. Okay, I did what I promised myself I wouldn't do, which was spend more time talking about spreadsheets than I did about the property. If we then just kind of go back and go right here. There we go. Okay, what next? So if you have any questions, my information is down here. We have an email. We have my phone number. And like I said, if you're interested but not sure, please give me a call and ask to take a tour of some of our other properties. They speak for themselves. Or themselves. Themselves. I think that's better. Then lastly, if you like what you've heard, you can click Invest Today. It's going to ask you some questions. This is open to accredited investors. If you are, you know it. And if not, then thanks for watching my video, but we can't talk to you right now. So you're going to go through here and determine the way or manner in which you're accredited. And this will walk through and give you instructions as far as how to make your investment, how to submit the investment, and everything should be fairly self-explanatory. I also encourage you to take a look from time to time at our investment portal. Maybe June is not for you, but you see something in the future that you like. So we have West, or we have something like that. Burnside says open, but actually we just closed it yesterday. So, but anyway, so we have June. I'm going to be putting West up there in just a minute. And look, we are always looking for interesting opportunities, and so this page is going to change from time to time. Thanks for taking a look at this video. Thanks for your consideration. And please reach out if there's any way whatsoever that we can help in the future.